I'll now do a quick walkthrough of the conference guidelines. All attendee microphones have been placed on mute. We'll have a presentation by the company spokesperson, which will be followed by the Q&A session as usual. The questions can be typed in the Q&A panel available to you, and they will be read out to the management in the Q&A session. I now invite George Matthew from Haitong Securities India to initiate the proceedings.
Thank you very much, Gaurav. So we at Haitong Securities, along with the fellow BRLMs, Axis Securities and ICICI Securities, are pleased to welcome you to the Broker and Analyst Meet for the IPO of Latent Analytics. The company was set up in 2006 by Venkat Vishwanathan, Pramod Jandhala, and Ramesh Hariharan. It provides consulting services, business analytics and insight services, and data engineering and other solutions. And counts upon its clients a very impressive list of Fortune 500 companies. Most of these companies are in the technology, CPG, and retail and BFSI verticals, and they are increasingly using the vast volumes of data at their disposal to solve complex business problems. And this is what LatentView does. So the company has grown organically till date without any external investment and has now decided to go public. The public issue will be up to INR 600 crore in size. This will consist of about 474 crores of primary capital raised to invest in growth plans of the company, and 126 crores of shares to be sold by existing shareholders. The IPO will be open from November 10th to November 12th for subscription. The anchor book subscription will be completed on November 9th, and the details will be released to the exchanges that evening. The price band has been set at INR 190 per share at the lower end and 197 per share at the upper end. We have seen substantial interest in the company from high-quality investors, and the details of this will be released after the anchor book subscription details are made public. Along with our fellow BRLMs, we are proud to be associated with this prestigious IPO. And now I hand over to the company founder and management team to walk you through the further details. Over to you, Venkat. Thank you very much.
Thank you, George. Thank you so much for the quick introduction. Maybe we could do a quick round of introductions of our management team before we go into the agenda for today. So my name is Venkat Vishwanathan. For the first 8 years of the company's existence, I played the role of the CEO of the company as well. But in the last 7 years, I've been working closely with our leadership teams. Rajiv Sithuraman, who leads our company now, I work closely with this team in ensuring we are adhering to all the aspects of running a fantastic business as we always done. Prior to LatentView, I've spent about 10 plus years in the financial services and IT services related businesses. I look forward to learning more about your interest today. I'll pass it on to Pramod.
Thanks so much, Venkat. Good afternoon to all of you, and a very happy Diwali to all of you as well. My name is Pramod Jandhala. At LatentView, over the last 15 years, I focused on building a strong platform for growth. In the early years, that has meant defining strategy and executing on that strategy. I've also provided leadership for our talent acquisition and management. Our business is a very unique blend of business, data, and math. And I've also spent the early years putting together a foundation for profitable growth for our finance team. Prior to LatentView, I spent over a decade in corporate finance. I started my career in the equity capital markets, transitioned to credit. A lot of my early skills in the finance sector have been very, very useful in putting together the foundation for LatentView. With that, I will invite Rajiv Sithuraman, our CEO, to introduce himself.
Thanks, Pramod. Hi, my name is Rajiv Sithuraman. I've been here at LatentView Analytics for the last 5.5 years now, initially in the role of Chief People Officer for the first 3 years, and in the CEO role since April of 2019. My past and background is mostly in management and business consulting, working with Accenture and KPMG over a couple of decades. The last 5 years of which was spent more in running different aspects of HR, including talent acquisition, capability development, and L&D. I also had the opportunity to wear the hat of the HR analytics lead during that stint. And that's when I got introduced to data analytics in a big way. Data analytics has been a fantastic combination of my earlier fuzzy problem-solving days in consulting, but using all the power of data analytics. So I look forward to the conversation today. We'll pass it on to Raj, our CFO.
Thanks, Rajan. Hi, everyone. Good afternoon and good evening. Wish you all a very, very happy Deepavali. My name is Raj Venkatesa. At Latent View, I go by Raj, and I head the finance function at Latent View. Currently working on this really, really exciting IPO project, which is a very, very significant milestone for the company as we complete 15 years this year. So we believe this is a significant milestone for the company and personally for me as well. If you look at my prior experience, the first half of my career really were spent in the consulting practices of some of the largest advisory firms in the world, where I specialized in mergers and acquisitions. Thereafter, I moved to the corporate side, where again I've donned multiple roles, but predominantly again leaning towards fundraising, mergers and acquisitions, financial planning and analysis, as well as handling investor relations. At Latent View, apart from of course heading the finance function, I also play a very, very strong role in business partnering as well as corporate finance. I'm really excited to be on this call today and look forward to having an engaging conversation with all of you guys. Back to you.
Okay, thanks so much, Raj, and thanks everyone. So maybe I could take a couple of minutes to quickly set the stage before Rajiv Sithuraman, our CEO, goes into a much deeper description of the business. So very quickly, the journey is a little over 15 years old, as Raj Venkatesa just mentioned. We started in 2006. Initial years were uncertain years around the 2008-9 financial credit crisis. But luckily for us, everything started lining up and going extremely well from 2010. Then the market turned around and we won our initial business relationship with Microsoft. I can still recall the times in 2005, 6, 7, where we were trying to identify the market space and how we capture data analytics as a completely new area. A lot of companies that spend significant sums of money in building out data infrastructure, and many of them were primarily drowning in data, starving for insights. And that's really the opportunity that we kind of went after. Between 2010 and 2021, we have had an extremely strong growth run where we've been featured in the Deloitte Fast 50 for 9 consecutive years, which we take a lot of pride in doing it for a sustained and consistent period of time. And Deloitte tells us no other company has done this after that. Here's a very quick snapshot of our business, just the 5 key reasons why Latent View would be an interesting investment thesis for anyone considering an investment. Number one is, as was mentioned right at the beginning, we are a pure play analytics player. We're one of the very few with such a specialized focus, and which is now available in the public market as well as we go through this process. Our business model is such that we are engaged by business users, and our focus is all around serving the needs of heads of marketing, heads of CRM, heads of supply chain, which is quite unique and different from what other services companies that have used India as a model. Number two, our client base is fairly blue chip in nature, and these are very large enterprises. 30 of the Fortune 500 companies in the world are our customers. And with many of them, we have deep and enduring long-term relationships, on an average over 6 years with our top 5 clients. And that tells you the kind of nature of our business and the kind of relationships that we aspire for. From a vertical perspective, technology vertical, which is primarily the Silicon Valley in the United States, is one of our largest verticals. This includes hardware, software, e-commerce, storage, networking, all the elements of the technology businesses. In addition, we are also present in industrial, consumer goods, retail, and banking and financial services. Some of these verticals have very large growth opportunities ahead of us. And part of the investment that we continue to do in the coming years would be about building out our capabilities so that we have a bigger share from each of these other verticals as well, in addition to consolidating our strong position in the technology vertical. Today, we have a very strong global footprint. United States is close to 90% of our business, or a little over 90% of our business. But we also have operations in 3 countries in Europe, Netherlands, Germany, and the UK. And these 3 countries, we believe, are home to 70 Fortune 500 companies, which presents a great opportunity for us to replicate all the success that we have had in the United States, also in the European markets. And once again, part of the proceeds of the IPO is also being targeted in terms of capitalizing and investing in each of our subsidiaries in these markets so that we can accelerate growth. Finally, we take a lot of pride in our history of being consistently profitable and having a very strong financial position. And achieving all of this primarily as a bootstrap business without raising any external funding so far, external equity funding so far. This should be the first time we are tapping into the equity markets. And our revenue has been consistently growing, as I mentioned, from the Deloitte Fast 50 accolades. Our margins have steadily been maintained in a very tight region with over 20% of ROCE and ROE, as we would covered in the later slide. And our PAT margins have been approaching 30% in the recent years as well. So we have a very strong business model, high quality customers, which allows us to charge the right level of premium and provide the right level of profitability. With that, I will pass the baton to Rajiv Sithuraman, our CEO, for him to go into a lot more details and answer some of your questions as well.
Hey, thanks, Venkat. I'm going to take a few minutes to talk about the spectrum of services that we provide in terms of the type of work as well as a value chain breakdown. I will also touch upon the industry segments that we play in. And then I will finally round it out with what we see as growth prospects and how we are going about addressing them. So firstly, in terms of the nature of the work that we do, Venkat did allude to the fact that we work mostly with large Fortune 500 companies with the functional and business unit heads of these organizations. And in many instances, the nature of the work is fairly fuzzy and ill-defined in terms of the problems that we are going after. So in most instances, there is a bit of consulting help that organizations require in terms of connecting the dots between the most pressing problems and opportunities that they have and how they can make use of data analytics to address them, which is where our consulting services come into play. Here is where we help organizations with preparing an analytics strategy or roadmap and creating a book of initiatives that they can pursue over the next several quarters based on the impact that these initiatives are likely to deliver, right, from a business metrics perspective. About 15% of the work that we do is in the nature of consulting services. However, it is the tip of the spear for us, and it helps us set us up really well in terms of the heavy lifting that we do as part of the business analytics and insight services. Here is where we help organizations with the look back and the look ahead analytics. And here is where we also make use of the latest in artificial intelligence and machine learning and modeling techniques to help them with the predictive and the prescriptive part of the analytics work. A lot of this work also involves visualization and reporting and dashboard work so that the results of this analysis and the models can be presented back to the business users and the decision makers, and that it is easily consumable for them so that they can take the right kind of decisions. Data engineering is the other big chunk of work that we do. About 20% of the work that we do falls under data engineering. And while we don't do the large-scale replatforming or cloud migration type of work. Much of the work that we do revolves around how do we create the platform, the data platforms and the layers that reside on top of existing data ecosystems. Could be legacy ecosystems, could be new tech stacks that they have, and it could be structured data from their enterprise resource planning and transaction processing system, as well as unstructured data, right, from the external world, social media data, for example, or data from their IoT devices and gadgets in their supply chain. And we help them use the latest in cloud-based architectures and technologies, such as Snowflake or Databricks or Amazon Redshift, to create that layer which can ingest data from all these multiple sources and set it up so that any kind of analytics is possible. So about 20% of the work that we do is there. And finally, solutions is really all the harvesting that we have done over several years, assets, accelerators that can help kickstart engagements and provide a bit of non-linearity in our revenue profile. And I'll cover that in a little bit more detail on the next slide. From a value chain perspective, a lot of the work that we do, 60% falls in the area of customer and marketing analytics. And here is where we answer questions starting around customer segmentation, but then on moving to lifetime value, cross-sell, upsell opportunities, loyalty, personalization, and so on. And as a reflection of that, right, on the marketing side, in terms of media mix modeling, marketing spend optimization, marketing return on investment analysis, going dark analysis, helping them with campaign analytics, and so on. So a lot of the work that we do is really at the front end of the value chain, helping our clients understand consumer behavior in a great deal of detail and intricacy. The rest of the work is split across the other areas: supply chain, finance, risk and compliance analytics, fraud and counterfeit falls in there, and also quite a bit of work around the HR analytics. These areas are starting to gain quite a bit of traction on the back of the pandemic, as most organizations have experienced some disruption or the other, right, to their supply chains. On the solutions front, which I touched upon earlier, there are three routes that we take to building these assets and accelerators and solutions. One of them is to do it on the back of customer engagements. And if we see an opportunity to abstract and create something which can serve a larger audience, then we go about doing that. A second approach is to build solutions on the back of the consulting work that we do. So if we see opportunities in the particular industries or the intersection points that we serve, we try and create accelerators and solutions that address the problems or opportunities at those intersection points. So currently, for example, we are actually building a set of solutions and value proposition around this entire on-demand economy. Everything seems to be moving to an as-a-service model. And what was earlier sold in a licensed or a one-time transaction kind of a model, whether it is a product or a service or a software, it's all moving to being consumed in the form of a subscription. So we have been helping several organizations on this front. And we are putting together a set of solutions that will help organizations make the transition to an as-a-service model, right? The entire the jing-bang in terms of the analytics and the data and everything that supports it. A third approach is our bottom-up Idea Labs approach, where we galvanize the larger part of the organization into creating ideas and innovations that might make sense. And we also work with external partners, including academic institutions, to set up contests and hackathons, and even for code reviews or algorithmic reviews, so that we are able to create very interesting solutions. So Casper and Spotcast that you see here are examples of solutions that we have built on that front. Smart Insights is a great example of a solution that we have built on the back of a customer engagement. This is work that we initially started off for a US cosmetics major, a lips and nails major, and they were starting to see some decline in their market share because younger, nimble companies were coming in and taking away market share based on trends that they were spotting ahead of the curve, and based on which they were coming up with some innovations. These trends could be trends related to techniques, such as microblading for shaping eyebrows, or it could be ingredient-related trends, like a tea tree oil or a moringa that goes into the product itself. Now, interestingly, many of these trends in the beauty and cosmetic space originate as far away as South Korea, and it takes a set of time to travel to the shores of the United States. And by the time it reaches the US, if you have not spotted the trend ahead of the curve and you do not have a product or an innovation, there will probably be half a dozen companies, right, which have already done that. So, and that is what's really happening in the case of this client. So we helped build an artificial intelligence platform that can ingest data from multiple social media platforms. Social media, especially Instagram, is a huge plays a huge role in the evolution of these trends in beauty and cosmetics. And we built this platform to ingest data from Instagram in the form of images and text and do analytics on that to find out what is trending, right? Is it a particular eyeshadow or a nail color or a lip gloss, for example, right? And who is talking about it? Who are the influencers? Therefore, which are the trends that are small today, but which are likely to become really big in the coming months? And who are the influencers? How big is this trend likely to get? So that is the platform that we built. Today, we can point this platform at many other product market segments and identify trends ahead of the curve. So this is a solution that we are able to take into many other conversations. From an industry perspective, Venkat alluded to the fact that we do a lot of our work for the technology space, or 2/3 of the work that we do, close to 2/3 of the work that we do is in the technology industry, and a very broad spectrum of companies there. Today, we work with 4 out of the top 5 technology companies in the world, and we help them on a variety of problems in their core as well as in their non-core areas. Non-core areas could be things like finance and collections or marketing. It could be around demand forecasting. It could be around HR analytics, for example. We also support them on very core business problems. The large internet search engine company that we have been working for example, we have been helping them on their foray into the e-commerce space when they set up the business as competition to the biggest in that space. Similarly, we have been helping them on their foray into the payment space, right, in terms of the analytics that supports them. And more recently, they have launched a short format video on demand offering in competition to the biggest player in that space. And we have been supporting, right, the analytics around that. So fairly interesting work supporting a variety of problem statements. Adobe has been a very interesting account to work with, and one which has grown rapidly with us over the last 4 years. We have helped them make the transition to the as a service model that I talked about. So 4 or 5 years back, if you bought a Photoshop or an Illustrator, it is in the form of a CD and you pay a fee for getting a license to use it. But today, all of Adobe's software is sold in the form of a subscription. And we have been helping them in that journey, right, as they have made that transition to a full as a subscription model. When we look at the other industries, whether it is automotive or oil and gas or CPG or retail, we see that there is a lot of excitement and interest in terms of amping up on their digital initiatives. Many of them have done quite a bit of work in the past in putting their data platforms in place, maybe getting some of the data migration and the cloud migrations done. But today, they are very keen and interested in learning from what the tech companies are doing, what companies in the digital native ecosystem are doing in terms of better understanding their consumers. And therefore, we believe that we are in a very, very good position in bringing all of that knowledge and capability and expertise that we have built working with the technology companies, but to help the more traditional sectors, whether it is consumer products or whether it is retail. From a relationship maturity and engagement standpoint, there are several accounts with whom we have very, very long-standing relationship. I can mention that for our top 5 companies, we have been working with them for an average of 6 years or more, and there are several relationships which are knocking on 10 years, have gone past the 10 years mark. Also, in terms of the engagement model, while early engagement models tend to be a fixed fee kind of a project where we work on a particular problem, a specific scope, and for a defined fee, once we help them and engage with them from a consulting standpoint, working on their analytics strategy and roadmap, we are able to set up a book of work that we can support them in their coming quarters. And in that case, we are able to move it to what we call as a long-term managed services kind of a construct, where we actually create an analytics capability, a team of people, both on-site and offshore, right, appropriate pyramid and all that, which will execute all of those analytics initiatives that have been identified as part of the strategy or roadmap. And these managed services contracts are governed by 3 to 5 year master services agreements. And the book of work itself is renewed year on year, right, based on the statement of works that we sign with them. Today, about 65% of the work that we do is in the form of managed services. And in the managed services kind of construct, there is a lot more stability and certainty around the stream of revenue, right, that is going to come to us in the coming quarters. From a go-to-market standpoint, we again take a fairly focused approach. There is a set of accounts that we pursue in each of the verticals in which we operate. It's a very high-touch consultative sales process, very similar to the nature of the work we do from a delivery standpoint. Given that we focus more on the higher end of the spectrum, right, from a value perspective, it is not adequate if we just show up and talk about our capabilities in building dashboards or in building models. We need to have very, very specific value propositions that we can take to our prospects and stakeholders. So it means that these value propositions should address the specific problems and the opportunities, right, that they have as part of their mandate. So it's a high-touch process, direct to prospect, where we craft those value propositions and then we take to them. Sales cycles can be long, but we are also rewarded by fairly strong relationships right on the back of that. Finally, from the opportunity in the market and what we are looking to do to address that, the industry section of the RHP will show that it's a very, very fast-growing market. It's expected to touch about $330 billion in about 3 years' time. And while quite a bit of that work might continue to be at the lower end of the spectrum, we believe that there is phenomenal headroom for growth in the high value add end of the segment, right, within the data and analytics space itself. And specific parts of the industry are growing at an even rapid clip, right, in comparison to the industry average of about 18%. So predictive prescriptive analytics, for example, is expected to grow at a much rapid clip. And we are focusing more on the high end, on the high value end of the spectrum. There are a few things that we are doing to address that opportunity. We are looking to deepen the partnerships that we have with the tech ecosystem. And these are companies like a Snowflake or a Databricks or a Redshift, for example, where we have technical partnerships, but we are also intending to deepen them to a go-to-market partnership as well. We are also doubling down on our consulting practice. We are focusing on adding to the bandwidth and the capability, just basic problem solving, issue trees, the creation of the value propositions that resonate with the market. So there are investments that we are making on that front. Across all of the industries, and both in US and in Europe, we are adding to the front end in terms of investments that we are making in the sales, business development, and marketing personnel. We are also hiring, and we have been bringing on people with deep expertise in each of those verticals, the BFSI and the CPG verticals that I talked about. And the idea is to marry that industry expertise with the technical and analytics capabilities, right, that we bring to the table so that we can pursue the right kind of opportunities. And finally, we are also setting apart a good chunk of the proceeds from the IPO for pursuing inorganic acquisition opportunities. We haven't done any acquisitions so far, but we see that there is a lot of action in this space. And there are several interesting small young companies with very solid IP and solutions and stickiness. So we have started evaluating some of those prospects. We believe that we'll be able to accelerate that exercise once we finish with the IPO, and we can focus more on that space. And we believe that there will be some very synergistic opportunities, right, that will emerge in the near future. With that, I'll pass it on to Raj to touch upon the financial highlights.
Thank you, Rajan. Before I start with the numbers, the one thing that I would like to lay out is when you look at our financials, the sort of standout feature that you will all notice is the high quality of earnings and as well as the high quality of assets that is reflected in our P&L as well as our balance sheet. And the core reason behind the fact that we have such high quality financial statements is that right from the beginning we've made very, very conscious choices with regards to the sort of customers that we want to work with, conscious choices regarding the sort of work that we want to deliver, and also the geographies that we operate in. And all of these conscious choices have helped us be what we are today. If you look at our track record, which is 15 years old right now, we've always been profitable. We've never had to resort to raising capital from any external sources. Historically, we've been entirely funded through internal accruals. And a big reason why we've been able to do that is one, the client set that we work with. If you look at our client portfolio today, we work with 30 of the largest Fortune 500 companies in the world. We work with 4 of the largest 5 technology companies in the world. And these are, by nature, these are all very, very large enterprises that are willing to pay top dollar for the work that we do. And the work that we deliver itself is more in the nature of high-end consulting work, which is why we are able to command a premium pricing for the work that we deliver. If you look at our average revenue per employee for the year FY21 on an annualized basis, we were close to about $65,000, which is despite an on-site to offshore ratio of about 1:5. And that is a testimony to the premium sort of work that we do. And what this helps us do is it helps us maintain a very, very attractive margin profile. If you look at our EBITDA margins for the year FY21, we closed the year with about 34.2% of EBITDA margins, which was one of the highest that we've ever recorded in our 15-year history. Of course, FY21 also had the one-time benefit of lower travel expenses and marketing expenses, which was close to about 2%. But most of the EBITDA improvement that we've been able to achieve is through a systemic change in the way we deliver work to our clients, and also a higher portion of the managed services work. Today, if you look at it, out of our total portfolio, 65% of that comes from managed services, where we are able to drive margins significantly better compared to what we were doing in the past. Now, the margins, the healthy EBITDA margins also flowed into our PAT margins. If you look at FY21, we closed the year with close to about 30% of PAT margins, which is the highest again that we've ever recorded. EBITDA per employee is again a very, very important metric that we track. And you will see that on this particular metric, we've consistently trended upwards over time. Moving on to the quality of the assets and the balance sheet, again, through the conscious choices that we've made in terms of the client set that we work with, and also the stellar job that we've done in terms of efficiently allocating capital as well as managing our working capital cycles, what we've been able to achieve is we've been able to consistently generate high cash flows from operating activities. If you look at our cash flows before taxes, historically, that as a percentage of the EBITDA that we've generated has been close to about 100%, which tells you that as to how well we managed our working capital. Now, the consistent high quality of earnings coupled with efficient capital management and lean working capital means that our return on capital employed as well as return on net worth ratios, both of them historically, we've tracked in excess of 20%, which again is something that we are very, very proud of. Before I sign off, the one thing that I would like to tell you is Q1 of FY21, you would have noticed that we recorded our revenue growth was close to about 20% compared to the corresponding quarter of previous year. Where we stand today, we see significant tailwinds in terms of both our current order book as well as new conversations that we are having with clients, both existing as well as new accounts. We see a significant uptick in the demand for our services, and we are very, very excited about where we are. Our high quality of earnings coupled with the strong balance sheet that we have, aided by the proceeds from the IPO that we intend to raise, we believe will put us on a very, very strong footing for us to chase the next wave of growth that is ahead of us. With that, I'd like to close our presentation and open up for Q&A.
Thank you, ladies and gentlemen, for that insightful presentation. We will now open the floor for the Q&A session. We have already received some questions, so while we take those up first, I'd like to remind everyone to pose their respective questions in the Q&A panel. We'll try our best to ensure that all queries are addressed. However, due to the limited amount of time, we may not take any repeat or follow-up questions. The first question: what is the normal duration of your contracts with customers?
So the managed services part of the work that we do, as I said, we have the master services agreement running from 3 to 5 years, but individual streams of work, the average is typically a year-long statement of work, renewable at the end of every year. For the fixed fee, fixed scope type of work, the duration can range anywhere from 2 months all the way to even a year and a half. There are 1 or 2 large engagements that we have done that have run up to 18 months in duration.
Thank you. Next question. Could you please update us on the Paycheck Protection program, and what are the benefits and what is the possibility of the company getting the approval for forgiveness application?
Yeah, so the Paycheck Protection program was essentially a grant given by the United States government. This was This was given to all small and medium enterprises who employed a certain number of employees in the United States right during the pandemic. We are working with our legal attorneys in the US to get an application to get a forgiveness from the United States government. From what we understand, we are very, very close to getting the forgiveness, which should be in the next few months. And this is something that we are tracking fairly closely.
Thank you. Next question. Could you please share what is your current positioning in Gartner's Magic Quadrant?
So the Gartner Magic Quadrant typically applies to only companies above a certain threshold in terms of revenue. We haven't hit that threshold yet. So we are not in the quadrant yet, but we have featured on some of their other reports, like the Cool Vendor report, for example.
Thank you. Next question. Why are you raising money as a company since the company has over 200 crores of cash? And what is the reason that the company has taken debt in 2021?
Raj, you want to go ahead? I can add.
Yeah. So I'll take that. In terms of why we are doing an IPO today and why are we trying to raise cash, you'd all appreciate that the space that we operate in today, which is the data and analytics space, the opportunity, if you had a chance to go through our RHP, the opportunity in this space is huge, and the industry itself is expected to grow anywhere between 18 to 20% over the next few years. And specifically the areas where we operate, which is more at the higher end of the spectrum, which is more around predictive and prescriptive analytics and data engineering, those areas are expected to grow at a much faster clip, right? And so what we believe is today we are just scratching the surface. The opportunity ahead of us is fairly large, and we believe that the IPO proceeds that we will get will help us chase these large pockets of growth, and that's the reason why we're doing an IPO at this point in time. The second question was, sorry,
that's on the debt.
Yeah, on the debt in 2021.
So the debt itself is essentially the grant that we received from the US government. I think I already addressed that. That was the Paycheck Protection program where we got a grant from the United States government, which is classified as debt up until the time we actually get that forgiveness.
Thank you. Next question. Can you elaborate on how you are using AI, maybe with a couple of more examples?
Yeah, sure. I can do that. I will talk about an example from the oil and gas space, right? We work with one of the largest oil and gas companies, and the problem statement that came to us was around the process flows that they had for manufacturing different petrochemicals. So if they have to manufacture something like a monoethylene glycol, right, they will be having multiple process routes depending on what raw material they start with, what are the process parameters and conditions, and what is the efficiency and other characteristics, right, of the process that they want to set up. So for making something like an MEG, they will have 20 different process routes, and they might have implemented these process routes in 200 different plants that they have set up right around the world. So the problem statement that was given to us was, how can you come up with the optimal process route for a new plant that they need to set up, given all of the process parameters and the conditions and everything, right? So this involved, first of all, scanning and understanding all of the different process flow documentation that was available to them and converting the whole thing into what we call a graph database. And this graph database has the weightages for all the different process routes and the nodes that are set up. And now, if you want to set up a new process plant, you can actually put in what are the process parameters and the conditions and the starting raw material, for example. And the artificial intelligence system will recommend what is the best route that you want to take. Now, this might seem simple because you're starting with the raw material and then you are looking to move to a particular end product in mind. Another example, which is kind of similar, but one where we are working with flavors and fragrances company, is a lot more exciting. This is around how do you reverse engineer a particular flavor or a fragrance, right? So this is akin to if a dish is put in front of a chef, for example, can the chef come up with the recipe for how the dish can be put together? So we are using artificial intelligence algorithms, again, to figure out if a particular flavor profile is given. A flavor can go into a food, it can go into a cosmetic, it can go into some into some perfume, for example, right? So the idea is, can you reverse engineer by starting from a flavor profile? So that is an example of another piece of work that we have done. We have used artificial intelligence and machine learning algorithms in a variety of demand forecasting scenarios. We have used it in scenarios where we have to figure out what is the optimal route, for example, right? That a truck or a salesperson has to take, given all the different customer calls that they need to make. One very interesting engagement that we worked on with a consumer goods manufacturer, for example, was around how do you predict what is the fault that a dishwasher or a refrigerator or a clothes dryer, right, or a washing machine might have, based on the call that is recorded from the consumer, right, by the customer care center. So when the customer calls the care center saying that these are the symptoms and this is what this are the noises I hear, for example, right, from the washing machine or the fridge. Using that, can we figure out what might be going wrong, right, inside the equipment? And therefore, can we estimate what is needed in order to repair that particular situation so that we can dispatch not only the right technician, but also the right component or part that might be necessary, right, to solve the problem. So we did this for a home appliances manufacturer, and it helped them dramatically improve the engagement of the consumers because they're now able to service these customers in a very short span of time. So that's another example of where we have used artificial algorithms. I can give more example, but I will save it in the interest of time.
Thank you, sir. The next question has come from a number of participants. I'm going to club it into one. Who exactly are our peers in the domestically listed space, and how same or different are we from them?
Right. So technically, there isn't anybody in the domestic listed space who is an exact match for what we do. Like I said earlier, we are a pure play data analytics company. And even within the data analytics spectrum, we focus more on the fuzzy, ill-defined problem space, which is what helps us command those premiums, right, in terms of the pricing and the revenue per employee that Raj alluded to. You have different organizations in the business and strategy consulting space, in the IT services and the systems integration space, as well as some of the product and niche companies that are having a go at this niche market that we occupy. But all of them come from various different angles. Typically, business and strategy consulting firms come from a business understanding perspective, but they might have challenges on the technology and the math and the modeling front. Systems integration, IT services firms have a go at it from the technology standpoint, but the other two dimensions might be a challenge. We have this interesting combination of those three skill sets that we bring to the table, right? The business, the math, and the technical aspects, right? And the combination of that is really what creates the market opportunity for us. As we mentioned earlier, we co-create the opportunities that we pursue along with our stakeholders to the extent that 80% of the work that we do, we are sole source. I mean, we don't compete with any of the other Indian or other companies, pure plays or otherwise, for the work that we do. Of course, some pieces of work the clients do come up with the initiative and then they sometimes decide to RFP it out or bring in some competition. But a lot of the work is around co-creating the opportunities on the back of very contextual, specific problems and opportunity that can be addressed using the power of data analytics.
Thank you, sir. Next question. Your top line hasn't grown much from FY19 to FY20 and FY20 to 21. Could you please elaborate on the reasons?
On the contrary, I mean, in fact, the top client that we have today, we have grown from from zero to $10 million in a 4-year time span. So I'm not so sure what this question is referring to. There is obviously changes that happen to the mix of which clients are there in the top 5, depending on which clients grow fast and which clients grow a tad slower. But in general, we have seen fairly strong growth from all of our top clients in the last 2-3 years, barring 1 or 2 instances where a client might have decided to, say, in-source and set up their own internal analytics capability. Of course, we did see some kind of hold back in the first half of the last fiscal year because of the pandemic. But the demand has come back very strong in the second half, and we see very strong momentum in most of our top accounts, right, as we have started off this new fiscal.
And if I may just add, while the numbers which you are seeing on the top line might have given you that impression, I would also encourage you to look at the profitability. There are some changes which the company undertook to drive the profitability. So the growth which is to be reflected on top line, the quality of growth improved and the quality of service improved substantially over this time frame, and that is getting reflected in the margins. There are multiple factors. People have tracked IT services. There could be changes in terms of onshore, offshore mix. There could be changes in terms of kind of services that the company might be chasing. As Rajan was alluding to, Latent View wants to focus predominantly on the higher end of the spectrum as far as analytics is concerned, and that is reflected in high revenue and EBITDA per employee. And each of these charts have kind of shown an upward trajectory. So I would encourage you to look at it a bit more on multiple parameters. Thank you.
Yeah, having said that, just to also add that the growth on the first quarter of this year will give you an indication of how, after all these changes that Arvind alluded to, the business is now back on a proper growth trajectory in line with the market opportunity.
Yeah.
Thank you, Raj. Next question. Your model is US-centric, like that of most IT services companies, and your attempts to foray into other geographies haven't yielded results yet. What would the growth strategy be going ahead? Would it be making deeper forays into the US or trying to penetrate other geographies?
Sure. The US is a very large market, right? And one that continues to grow at a breakneck pace, whether it is IT or digitization or data and analytics services. So therefore, we will, of course, continue to do justice to the opportunity that is there in the US itself. But as pointed out earlier, the Europe is also a very interesting market. I mean, it is home to 70 out of the Fortune 500 companies. And today we work with only 2-3 of them. To summarize, our focus has largely been on the US, given management attention, bandwidth, right, and whatever resources are there in constraint. But today, we believe that it's the right inflection point. I mean, the pandemic has provided an opportunity for most organizations to accelerate their digital transformation initiatives. So Europe today, there are multiple conversations that we are having around new age data architecture and data engineering, but also very strong interest in supply chain analytics, right, and risk analytics, for example. So we are doubling down on building capacity, both in terms of the front end, right, sales and business development bandwidth, so that we can pursue those opportunities. But equally important, the back end, the delivery capabilities that are needed, right, to pursue those opportunities. This is something that is already underway. And we will definitely be using proceeds from the IPO, right, to further drive the action on that front.
Also, just to add to what Rajan said, from a potential standpoint, the 3 geographies where we operate in Europe today, where we have a presence, be it UK, Germany, and Netherlands, account for about 70 of the Fortune 500 companies. And we believe there is significant room to scale up, which is why, like Rajan mentioned, the IPO proceeds will go on to supplement and beef up our frontline sales engine in these regions. And we will look to also bring on domain experts to drive growth in the European region especially.
Thank you, sir. Next question. Your operating model is asset light, with interest and depreciation being minuscule compared to your EBITDA. Would the model change going ahead or remain substantially the same?
So we will continue to be I wouldn't say asset light, but we are very efficient in the way we manage our capital. So that is as an attribute or as a quality of the business is will not change. We will continue to be efficient in the way we allocate capital, but we will spend for the right things. And so in that sense, yes, for us, the interest or the depreciation expense as a percentage of our overall EBITDA will always continue to be substantially lower.
Thank you. Next question. From what percentage of customers do you get repeat orders?
So if you look at, yes, Rajan,
Go ahead. Yeah, I'll add in if required.
Yeah. So if you look at our typical revenue profile in any year, 85% of our revenues come from our existing clients, and about 15% of our revenue comes from new customers that we add in any particular year. Rajan spoke about the managed services model, which accounts for about 65% of our overall business. The rest of it coming through either fixed term projects or fixed price projects or time and material contracts. Even within the managed services model, about close to about 80 to 85% of our entire business is driven by SOWs or contracts that are extended or renewed on an annual basis. So a fairly significant portion of our business is repeat business.
Thank you. Next question. On the managed services portion, how has that percentage, how has managed services as a percentage of revenue trended over the last few years?
Yeah, we have moved from about approximately 40% in the FY19 kind of a time frame to about 65%, right? So it's increased by about 25%, largely on the back of reduction in a book of work, which is more in the nature of providing point expertise, right? The time and material type of contracts that Raj talked about, more of on-site roles. And that is the book of work that we decided to exit because we felt it made more sense to focus on the more enduring managed services kind of a model. So yeah, improvement of about 25% over the last few years.
Thank you. You mentioned that around 50% of your revenues came from top 6 clients. Are the top 6 clients all in the technology sector? And what is the revenue split and margin split across the 4 services offerings that you mentioned?
I'll take the revenue split part of it, and I'll also maybe touch upon the margin split. Raj, maybe you can address the first part of the question. So the revenue split across the sectors, I think we have already shown, right? The industry sectors. I mean, technology is about 62-63%, and then industrials is a good chunk, about 17%. CPG, retail, and BFSI make up the rest. From a type of work perspective, consulting is about 15% of the revenues. Business analytics, the heavy lifting that we do, right, in terms of the look back, look ahead, the data and the business analysis services, that is about 60%. And data engineering is about 20% of the work. I mean, then the rest of the stuff will be in the nature of some of the non-linear lift we are getting from the solutions that we have in place. The margin profile is not very different from an industry standpoint. Of course, technology, we are able to command higher margins because most of the work, pretty much 80-90% of the work that we do there is of a high value add, high end of the spectrum. Therefore, even though we are working with the tech companies that are many instances inventing the tech stack and the data analysis approaches and the algorithms, they hire us because of the value add that we are able to bring to the table. So therefore, it tends to be higher value add, higher margin work, most of the instances in the tech industry. For the rest of the sectors, depending on the nature of the work, the margins can vary. Typically, you will see that margins for look back analytics, where it is largely around reporting, dashboarding, some insight generation, and some analysis, will be slightly lower premium in comparison to the look-ahead analytics. Data engineering, again, depending on whether you're building the new architectures and you're doing the more complex data engineering work where you're leveraging a Snowflake or a Databricks, for example, right, to build the new stuff, that would be at a premium in comparison to simple ETL or migration from one platform to another. We tend to focus, again, more on the higher value add work, even within the data engineering end of the spectrum. So in general, the profile will be along, margin profile will be along those lines. Raj, do you want to touch upon the first part of the question?
Yeah, the first part of the question, I think, was top 5 customers, are all of them from the technology vertical? Was that the question?
Yeah, which verticals?
Yeah, so all of the top 5 customers that we have today are all from the technology vertical. That is right.
Thank you. Next question. This is on the valuation, so I'll also require bankers to chip in here. How do you justify the valuations that you're hitting the market at? The price to earnings looks at like it's at around 38 to 40x.
So maybe I can take, or Arvind, do you want to go?
You can take. I can just step in.
No, I think so. We have done a very extensive marketing exercise over the last couple of months with QIBs. As you note, there's also 6.2 issue, which is basically 75% QIB. And seeing that this is a very differentiated pure play analytics company, probably the first of its type to hit the Indian market, working at cutting edge of technology with a large market opportunity ahead of it. A lot of the feedback from investors and for our ability to arrive at the valuation range, which was acceptable to them, was on account of these features of the company, as well as the opportunity space that they are going after. So we have met over 100 investors, as our fellow book runners will also testify. So we have actually come up with a very high quality set of investors who have comfortable with this particular valuation range. And that's how we arrived at the valuation.
And maybe I'll just add a bit more to this. There are two ways in which you can look at it. If you look at the global IT services spends, the legacy part of the spends is kind of flattish. But if you look at the digital spends, they are growing pretty fast. And amongst the digital services, the one which is growing a bit faster than the others is analytics. Analytics, if I were to look at it from the entire digital bucket, which is a SMAC, social media, mobility, analytics, cloud, AI, ML, customer experience, and so on and so forth, the analytics is pretty interestingly placed. $175 billion still growing at 20%, and outsourcing is still at its nascency. So to that extent, industry is pretty well placed. Unfortunately, there are no listed players for latent analytics in India. But having said that, if I were to just broaden the horizon and look for 100% digital services companies, you have likes of Happiest Minds listed in the market. And we all know the valuation range at which Happiest Minds are kind of trading at. So the company's IPO post this extensive marketing which George was alluding to, and speaking with a plethora of investors across geographies, you arrived at around 36 to 37 times on a FY21 PAT, which I believe is fairly attractive when compared to what the peer which I was alluding to is currently trading at. And globally also, this you can look at some of the peers and they are trading at a substantially higher valuation. Company which is growing, which is in an industry which is expected to grow at 20-25% having a track record of servicing some of the blue chip names, having scaled up within their ecosystem, having added new logos, and doing so in an extremely margin accretive way. We believe the story justifies the valuation that we are talking about.
Thank you. Next question. If the data analytics opportunity is so large and attractive, could you tell us what are some of the challenges that the company faces to grow at a faster clip?
I would say that almost hardly any challenges on the demand front, right? I mean, I did mention that we co-create a lot of the opportunities sitting along with our stakeholders. We believe that the pandemic is already serving as a very, very important inflection point for clients and prospects to pursue the more interesting, complex, higher end of the value spectrum, right, type of engagements. And that is really the area where we specialize in. There are challenges that organizations talk about in terms of supply, availability of high caliber people, right, and then making sure that we are getting the right mix of people to the table. This is something that we have handled really well in the past. Good part of that, I mean, even though attrition in data analytics is slightly higher in comparison to IT services, we see most of that attrition only in the 0 to 4 year experience type of range. There's a lot more stability when it comes to people with people at an assistant manager and beyond levels, and that means that we are able to get much of our talent from campus hiring, right, as a route, as opposed to resorting to lateral hiring. I mean, of course, we hire from the market as well for any new esoteric or point skills, but otherwise we have been able to largely rely on the campuses. We have a very strong relationship and connect with the campuses that we go to. Some of them are the best campuses, right, within the country for engineering, for management graduates, and so on. So we feel quite comfortable at this time, even from a supply perspective. I think what we will have to look at is how quickly we are able to translate all of that learning and expertise that we have built by working with digital native companies in the technology space, and how quickly can we convince organizations and prospects in the more traditional sectors, right, to adopt some of those new age approaches and interesting opportunities that might be there, so that they can leapfrog the competition, that they can do well. So I would say that it's that constant endeavor. And it is in relation to that, we are stepping up on the consulting side of the practice, because that's the part of the practice where we actually co-create and collaborate with the stakeholders in terms of the art of the possible and help them push the boundaries, right, in terms of how data analytics can help them in getting there, in addressing their business priorities.
If I could just add to that, possibly not a challenge, but I think a key characteristic of our space is it's very fast changing. So even when we started off 15 years ago, at that time, it was predominantly structured data that we were working with. And if anything, textual data was the new frontier at that time. That goalpost has changed, and it has changed so much in the last 15 years. So working with textual data is now so commonplace. All of us are so used to looking at speech to text kind of tools that are available even on the conferencing tool that we are using right now. But that has moved to newer forms of data. So if you kind of look at image data that we talked about, some of the artificial intelligence work that we've done has been using images. Video is the next frontier now. A lot of work that we do is also using sensors, the connected world, and IoT. So I think a very key characteristic of our sector is to be able to constantly unlearn, relearn, and stay ahead in terms of the new techniques and the new forms of data which are available out there. And that, I think, is something which keeps a lot of our young talent really excited because it gives them an opportunity to work on some of the best problems that are available out there.
Thank you. Next question. What are some of the empty spaces in your current portfolio of products or services that you wish to fill via acquisitions?
So, rather than call them empty spaces, I would say that these are maybe under-penetrated for us from our perspective. And as we also shared during the presentation, from a geographic perspective, Europe is largely under-penetrated, right, in comparison to the work that we do in the US. Likewise, we are largely concentrated in the technology industry, and we mentioned that there is a lot of interesting emerging opportunities in the more traditional sectors. So our objective from an acquisition standpoint would also be to try and find opportunities that help us get a very big foot in, right, into those segments, whether it is geographic or whether it is industry. we would want to stay aligned to the wheelhouse in terms of the nature of the work that we do. There might be a few adjacencies that one could explore on the data engineering front, for example, right around data operations, or there could be opportunities in specific areas of marketing analytics that we do, for example, around campaign analytics and operations, where there might be some opportunities that we could evaluate and pursue. But largely, the plan is to stay aligned to the wheelhouse and use acquisitions as a way to really significantly up the take on the more underpenetrated segments where we are already present.
Thank you, sir. Next question. What is the sort of hiring policy that you pursue, and what is the sort of attrition rates that you see, given that data analytics in particular is a fast-growing and fast-churning industry?
Yeah, the hiring policy I kind of alluded to. I mean, there is some amount of lateral hiring that happens in order to fill in for point skills and expertise, and especially in relation to the point that Pramod made, given that it is a fast-changing dynamic space, sometimes we do need to ingest skills from the outside. But the bulk of the hiring increasingly, right, starting already this year, is focused more on campuses. And we have built a good set of campuses, right? Relationships with a good set of campuses over the years. We go to some of the best campuses in the country, whether it is management talent, right? We go to the IIMs and comparable colleges. When it comes to engineering talent, we go to the NITs and the IITs and BITS and VIT, and also good universities in the South, including Anna University, for example, or PSG, for example, in Coimbatore. So there is a good set of campuses where we get our engineering talent from. We have started getting talent also from math and economics and slightly other differentiated backgrounds in recent times. And we do see that that is also paying dividends, just in terms of diversity, slight diversity in thinking, right, and background. And many of them are actually playing a very important role in terms of the perspectives that they are able to bring to the table when we are solving for some of the more fuzzy problems that I talked about. So it's a largely campus-oriented hiring model that we have at this point in time. We have done some off-campus drives as well, where we see people completing a course, for example, right after they finish their undergrad or postgraduate studies. So we've been able to leverage that as well. From an attrition standpoint, we are comparable to what you see within the data analytics space. It's in the low 20s, and we see some amount of stability starting to return now. I mean, I know that the first 2 quarters were crazy. I mean, in terms of there's a lot of pent-up demand, which kind of got unleashed, right, once the pandemic started winding down. But attrition is something that we are tackling by the value proposition that we are able to bring to the table, right? I mean, that is, of course, I mean, from a compensation and Ben perspective, we are at a premium already in comparison to the IT services companies. And that is also an important point. But more important is really the opportunity to work with the kind of marquee clients and accounts that we work with, solving some of their most impactful business problems and opportunities. So that tends to be the more interesting part of the value proposition, right, that we are able to put in front of our people. We also have a very, very strong L&D program that allows our people to understand what is trending in the market from a data analytics perspective, and then choose on their own how they would like to spend the budget and the dollars that are available for them, right, to learn and learn new skills and upskill themselves. So in some sense, the freedom and the flexibility that is available for our people to learn and upskill themselves and pursue the right kind of opportunities is another very, very strong aspect of the value proposition. So with all that in mind, I mean, we are not worried about the attrition that is currently prevailing in the industry. In fact, we are using attrition in 2 ways. Positively, one is many of our people who leave us, they go on to join interesting product companies or client organizations, and they become our brand ambassadors once they are part of those organizations. Secondly, we know that many of our people leave for higher studies and so on, so we are able to bring them back in after they complete their post-graduation. And we also use it positively in terms of pyramid refresh, right, and managing churn to keep costs under control. So all of that is okay at this point in time. And we are comfortable with how we are handling the attrition that we are currently experiencing.
Thank you. We'll just take the last couple of questions for the session. So what is the total number of employees in India and outside India? And what is the onshore-offshore mix?
Right. The total number of employees is kind of just gone past the 900 mark. We have, out of that, about 125 odd people are in the US, largely on-site. We have 1 or 2 people in Europe as well. Europe kind of moved more to a remote model over the last couple of years, but we are starting to add people back there. And the on-site offshore ratio, if you just take the people who are in the business, people who are part of delivering the services that we provide, that will be currently around 1:5. And we expect that that kind of a ratio will continue in the near future.
Thank you. The last question for today. Despite being profitable for the last 3 years, why does the IPO only have 10% proportion for retail investors?
Arvind, you want to take that, or this is
Yeah.
Yeah, this is basically a regulatory requirement. So it is because there is a substantial cash on the balance sheet. Management has historically been extremely conservative in taking dividends, and they have always reinvested in the capital back into the business. So if ever there is also a regulation with respect to the proportion of financial assets as a percentage of overall assets, since there is substantial cash on balance sheet, as was noted by other analysts who was there on the call earlier. So that is the reason why it is 75%, 25% instead of having a really consistent track record of profitability. It is basically a peculiar situation which we hardly encounter, where a company is so profitable and that cash continues to remain on the balance sheet of the company at the time the company goes public. Kudos to the management for that kind of a high level of corporate governance and conservatism towards the balance sheet strength. That is the reason why we are faced with this situation.
Thank you. Thank you very much, ladies and gentlemen. That brings us to the end of the Q&A. Now, let me invite Mr. Arvind Ganeshan from Axis Capital for the vote of thanks.
So good afternoon. Thanks a lot for everyone for attending this extremely interesting virtual broker/analyst meet of Latent Analytics. As you might have already, this is the first company in this extremely interesting space to get listed. I'll just kind of tabulate a couple of key pointers which I believe might be useful and relevant for you. This is a 100% digital services company with focus exclusively on analytics. Again, something which is not seen in the listed space in India as far as analytics is concerned. Analytics, as the management articulated, is an immense growth opportunity and requires a very well-rounded expertise. You need to have great depth in the verticals, functions, math skills, and the programming skills to kind of offer this kind of service to the end customers. To that extent, it is a bit of a difficult skill set to assimilate. Company has shown a track record of scaling up within some of the best names in this industry. They have been able to retain them and scale within their ecosystem. They have also had a great sales teams which has helped them add new logos. And company has kind of capitalized this entire opportunity in a margin accretive way. So I would again like to thank Venkat, Pramod, and the rest of the team for trusting us and the entire syndicate to take this incredible company going public. Just few data points for your consumption. The total size is 600 crores at the end of the price band, which includes a primary of 474 and an offer for sale of 126. The price band is 190 to 197. Issue is opening to public on Wednesday, which is 10th of November, and closing on Friday, 12th of November. Anchor book, you will see it closing on 9th of November. We have, as George was alluding to, met quite a bit of investors across the globe, and they have received a fairly good response, and that will come out soon. We wish to seek your support in making this IPO a well-rounded success. Thanks a lot for taking time out again. Stay safe. Thank you.
Thank you. Thank you, everyone, for joining the virtual Brokers and Analysts meet. Please feel free to reach out to us for any further queries or email us at ipo@adfactorspr.com, and we'll do our best to reply to your queries at the earliest. Take care, stay safe, and have a very happy Diwali. Thank you.
Thank you all and happy Diwali.
Thank you all and happy Diwali.
Thanks, everyone. Happy Deepavali.
Thank you all. Happy Diwali.